Good afternoon, everybody, and welcome to the latest episode of Conversations on the Couch here at Empire. The scale of funds that we manage here at Empire means that we get access to often unique investment opportunities, those that may not be available on retail investment menus. But it also means that we have access to people within those fund managers who are making the decisions and influencing the outcomes within those funds. And today is one of those opportunities, and we're very, very pleased to have Mark Burgess join us today. He's the chairman of the advisory committee at JCB. JCB manages two of the bond allocations within the Empire managed accounts. So we've had a wonderful opportunity this afternoon to have Mark and Angus from JCB come along and share their wisdom with our group. So welcome, Mark. Pleasure to have you along. Now, Mark has a very impressive resume and backstory. So I won't be able to do it justice by trying to remember it. So I will read it because Mark is one of Australia's leading investment management figures. He's held leadership roles in investment management for over 3 decades and brings that wealth of experience to the JCB advisory board. Prior to taking on that role at JCB, Mark spent 3 years between 2011 and 2014 as the CEO of the Australian Government Future Fund. So that's managing $110 billion with Australia's sovereign wealth fund. Prior to that, he was the CEO of the Treasury Group, managing around $17 billion in aggregate funds, the Vice Chairman and CEO of Credit Suisse Asset Management in London, the Global Chief Investment Officer there with over $250 billion in funds under advice. And also held a number of other leadership roles, such as Global Chief Investment Officer for American Express Asset Management, Colonial First State Investments, and Bankers Trust. Wow, how did you fit all of that in the last 30 years or so, Mark? That's an incredible backstory.
Well, I'd summarise it as age, basically. But I've had a fortunate career, and it's been a good career for most investors, actually. Yeah.
Well, look, with that sort of experience and running those sorts of portfolios into the hundreds of billions of dollars, it's been our pleasure to have you here with us today and to share those insights with the Empire team. Given that very unique set of experience and serving on boards and investment committees in some of Australia's largest superannuation funds and funds management, and working with family offices both here and globally, can you share with us your thoughts on what you think separates great investors from average investors? So what makes the great investors successful consistently?
Yeah, it's a really great question. And the fact that you're asking that is a good starting point, because a lot of people don't ask about the process of good investing and how people pull investment portfolios together. In fact, I was based in London for about 11 years, turning around asset management companies that hadn't performed very well. And you learn very quickly that if you don't have a good process, a good structure, a good framework about the way you think about investing, you'll probably be either average or below average as a general observation. There are many different approaches to investing, and they can differ between organisations. But where organisations get into trouble is that they don't have a structure or process. So, for example, I know at Empire you've got a process to the way you approach clients, the way you construct portfolios, the way you think about moving asset allocation, selection of manager. Those kind of issues are critical to really good investment process. So it sounds dull. People think investing is about the art of investing, but a really good structure and a way that you approach it will give you really good results over time, because you'll be able to deal with the robustness of both good markets, but also the kind of emotional experience when markets are sometimes not going your way, or we're just having a cyclical downturn. So it's about structure. And as I've gone into organisations over my career, you walk into a shop that doesn't have a structure, you know pretty well that the clients aren't being run well, or the money's not being run well. You go into a shop with a well thought out approach, as the Future Fund had, you're likely to get good results.
It is very difficult in shifting market conditions to hold firm and maintain those convictions and be patient and believe in the structure, isn't it?
It's really difficult for our clients, right? It's difficult if you're not involved in investing on a day-to-day basis, which is really, frankly, why you have an advisor, is because you don't want to have to worry about it day to day. So what's your risk, I guess, if you're not an investor, you're a client, you've done really well, you've raised money, you've got superannuation savings. The key is to have a medium-term to long-term view, very important. Secondly, talk to your advisor about the way they go about investing, the ups and downs. They should be able to tell you, look, we've had a great year, for example. We think the market's probably gone a bit too far. Don't compound this 20% year we just had. It might set back a bit. Get used to the ups and downs of markets. One of the things I say to young people, if they're starting out with a super fund at say 20, probably by the time they turn 60, they'll have 4, maybe 5 times of even bone-chilling corrections in markets. But if you look through it, if you've got good process, you'll compound over that period and have terrific savings. We all just have to learn how to manage through it, and really working with your advisor is probably a key part of that process to help you get over the emotion of the roller coaster that markets can bring. Yeah.
All right, great insight. You've worked, so those insights have been gleaned from working both locally here, but also an impressive career working overseas. What do you see Australian investors do differently to overseas investors? Better or worse? So how do we compare? What do we do differently?
Yeah, look, if I asked a foreign investor or somebody observing our market, somebody who's in the industry, they would probably give Australia pretty high marks. And they give pretty high marks because Australians are quite creative. We tend to build well-diversified portfolios. We tend to look for, we're open to ideas, new areas to invest in, but in a reasonably structured way. And you find this across the piece. You find it both institutionally, but you also find it in the advisory market. Australia's pretty well armed. Why is that the case? It's because we've had a savings pool now here for 40 years. We've also had good outside advisors. In the early days of superannuation, some of the major global consultants came down here and really taught the industry a lot of skills about diversification. So Australian funds are generally, I think, well diversified, creative in the way they construct portfolios, and now, as we've learnt about it, long-term in their focus. Some funds in Europe, for example, only have fixed interest. Now, I'm an advisor to JCB, and we probably love everyone to have only fixed interest, but that's not an advisory, well-balanced growth portfolio. But so some markets around the world haven't developed like we have, and so we've got this sense of diversification. The way we construct portfolios is better, I think, than many other markets.
Yeah. Good. Observing that, what do you think is the most common mistake that investors make?
Yeah, the most common mistake that can be made, well, there's a few. Let me give you a couple of warnings. One is to take a short-term view. It doesn't matter how you look at it, being short-term when it comes to building wealth is a dangerous and perilous business. There might be 1 or 2 investors that can do it, but it's not sustainable. You've got to really have a 3 to 5 year view. And as I said before, part of that is dealing with the emotional, the occasional market setback. The law of compounding says stay in there. Reposition perhaps on occasion with advice, but compound forward. A second thing, which is a very common mistake, particularly if you've got some money, you're down at the golf club, you're with friends at a dinner party, when people give you sort of ideas that are becoming popular, be careful, because if everybody's doing it at the same time, there's every chance that it's already in the price, and 2, it might be becoming overdone. And we've seen this before. The 2000 tech bubble was really a lot of people talking to each other, convincing each other that this is easy money. We saw it a bit with crypto, I think, at one stage there. So, don't get caught up in peer group. And third, I think, talk to your advisor about your objectives, what you're trying to achieve, and really take a bit of ownership. And also, I personally wouldn't hesitate to get educated about it. I always think that the best client is the client that now knows how to invest after a 10, 15, 20-year relationship, because it gives you confidence to ask the kind of questions that you want. But yeah, don't get caught up in peer group pressure, and take a medium-term view is probably the most important.
They're very difficult in this. We talk about the short-term news cycle and how that affects politics and things like that. There's not a lot of thought given to how that affects investment markets and the choices that retail on the ground investors are making. Let's take institutional investors out of the equation. There's a lot of noise, a lot of information, people chasing that quick win, and you're right. They very, very rarely work out the way that they hope they would.
Yeah, I must say we should remember institutional investors can get caught up in that as well. We're all prone to it. And so you're absolutely correct. Building wealth is not about this year's numbers, tomorrow's Fed meeting. It's about setting strategies over the medium term. Sure, adjusting as you go through those cycles, perhaps, with advice. But you're absolutely correct. We're in an environment where people want to make you act. They want to prod you with a piece of news all the time. That actually can damage portfolios. And so you've got to have a sort of a medium-term approach if you really, really want to be wealthy. Look at the wealthiest people. That's what they do. Yeah.
That's really, really sound insight there. And talking about those cycles, I guess just to finish off, and you viewed a number of these cycles, and you talked about young investors and what they're going to see over the next 40 years in their superannuation funds. What challenges and what opportunities do you see presenting for investors over the next 20 years?
Yeah, look, one of our major themes is that, and it's a theme of my career, which is the last 40 years we've had some really favourable tailwinds. For example, interest rates have been falling through the 40 years, and for those who don't follow investing closely, that lifts the value of everything. It lifts the value of house prices, lifts the value of equity portfolios. We think that interest rates are now probably going to go sideways for a sustained period, probably a decade even. And in that environment, the assets you pick, the way you select them, are going to be even more important than it was in the past. In other words, the quality of the investment that you have, the type of company it is, the type of asset it is, how much leverage you have against it, all those will be far more significant drivers than just the tailwind of a very long-term falling rates. We may also not have a period where central banks have just continued to bail us out. My career started in 1987 or thereabouts, showing my age, and one of the great features of the 87 crash was the central banks bailed us out, and less than 2 or 3 months later the markets were back. In the next decade, it's quite possible that we won't necessarily get those sort of solutions. It's nothing to be worried about, but what it does mean is that your advisor has to select assets well, think about construction portfolio. Those core skills and techniques, some of the questions you've asked me today, will actually be the biggest component to the future return is those techniques. Really, for parts of the last 20 years, you could have just owned anything and made money. That's not likely in the next 10 or 15. It doesn't mean we need to be bearish. It doesn't mean you're not going to get great returns, but it means that the skill of advice will actually be far more important than it was with just the tailwinds of falling rates.
All right. Mark, thank you very much. It's been our absolute pleasure and honour to have you join us here today and share those insights, not only with the Empire team prior to this discussion, but also with our clients and with the wider Empire community. If there is any questions that anybody has, obviously they can get in touch with us here at Empire. We'd be happy to have those discussions with you. But Mark, thank you very much once again for coming along.
Thanks for inviting me. It's great.